Hello, my name is Brad Etheridge. I'm the Chief Marketing Officer for the Center for Tax Strategies and Resources. Welcome to our webinar. Today's topic, defining a true financial planner. It's really interesting what some folks think a planner is and what a planner actually is and what a planner actually can do. And you know, the really good news is that if you do the job the way that you should do the job, it will definitely increase your practice revenue. Our speaker today that's going to be talking about this is Simon Singer. For those of you that don't know Simon, he's been successfully in our industry since the 60s. He has written 4 business bestsellers. He's a sought-after speaker, and he's in the top 1/10 of 1% of all financial planners in the U.S. What makes Simon pretty unique is a couple of things. He's a coach by nature, so he is the one of the original founders of the center, and he's still an active practicing advisor, and the guy has more energy than anybody I've ever met, especially in our business. But he's got really strong feelings about that. So today Simon is going to talk about that definition of a true planner and what the advantages to your practice might be. For those of you that aren't aware of the Center for Tax Strategies and Resources, we are a membership-based group. A lot of people have described us as a study group on steroids. Folks want to become a member. If they qualify to become a member, they get to share in unbelievable resources that the center has, a lot of which are built around showing your clients how to reduce their current and future taxes, which we think is probably the best way to start a relationship. There's a bunch of benefits of being a member. I'll touch on a few of those as we move through the presentation. But enjoy Simon. At this point, I'm going to turn it over to Simon, and I'll be talking to you again in a few minutes.
Okay, so we're going to talk about the public's perception of financial planning. We're going to talk a little bit about thinking outside the box. We're going to share a little bit about replacing the loss of taxes for errors of qualified plans, and then we'll talk a little bit about the academy that we just kind of glossed over just now. So let me start this with what is a financial planner, what the public believes they do, and what they should be doing. Well, most people who call themselves financial planners merely create investment portfolios and manage the assets. That's what they do. And I don't think we've got any investment only people, so I think you're going to relate to this. But that's typically what financial planning has mostly become as far as the public is concerned. In our opinion, there's much more to being a financial planner than just supervising investments. Assets need protection, risk elements need to be controlled, retirement needs funding and distribution, and taxes, income, gift, and estate tax should be reduced. Now, if you layer that together with managing the investments, you've got what a financial planner is supposed to be. All of these need creative thinking, and I think we all agree that taxes have nowhere to go but up. So consider this example of how taxes can affect retirement. This is going to be old hat to some of you, but if you took $1 every year for 20 years, use 100% annual earnings, which of course is impossible, at the end of 20 years, you'd have over $1 million. If you do exactly the same exercise, make 100% every year, except subtract 35% in taxes every year, you'll wind up with only $22,377 at the end of the same 20 years. That's the difference between 100% net earnings and 65% earnings. Paying taxes on annual earnings produces a huge difference in saved money. Tax planning is at least as necessary as yield, and they are far more controllable. And here's the important part. You don't have to give the saved taxes back if the market crashes, and the market always crashes at some point in time. Financial planners should also consider lifestyle needs, risk elements, and asset protection, all of which are at least as important as picking an investment portfolio, watching it go up or down, getting paid no matter the outcome. In addition, your clients are all subject to the claims of judgment creditors. They may not think they are. They may say, well, you know, I've got my property and casualty insurance on my apartment buildings, or I have my malpractice if they're a physician. But the fact remains is if one of your employees gets in your car to run an errand for you and runs into a school bus of kids, trust me, your malpractice and your property and casualty isn't going to be enough. So fostered by a damaged legal system that allows the filing of erroneous claims coupled with nuisance settlements with no penalties for filing meritless lawsuits further compound the negative issue. Why has financial planning become all about chasing high yields and risky portfolio with little or no attention paid to reducing taxes without any risk of principal whatsoever? Remember, once you save the taxes, they're yours forever. Your clients should be paying attention to the financial planner, hopefully you, who talks to them about all the elements of financial planning, including tax reduction, guarding against risk, managing cash flow, protecting against the claims of judgment creditors, and designing retirement strategies, not just retirement contributions. These are all issues that serve your client far more efficiently and completely. Financial planning is not, or should not be, just about assets under management. To some of you, this is going to be familiar, but I think it's appropriate for how we conduct our business and how we suggest you conduct yours. There's an old puzzle called the 9-dot puzzle, and your goal is to place 9 dots on a page, 3 on each line, as you can see here, and then with 4 straight unbroken lines, join all the dots without lifting your pen off the paper, and you do it in a continuous motion, crossing each dot only once. Give it a try. So I'm going to show you what happens. 1, 2, 3, 4, you missed the middle one. Try it again. 1, 2, 3, 4, you missed the one in the bottom center. The problem is what we all see here is a square. Well, there is no square. What there is 9 dots. So if you follow the rules and don't limit yourself by self-imposed boundaries, self-impose the operative words, you can accomplish a lot of things. So you need to think outside your own self-imposed boundaries. It's a way to get people to listen and to open up. Outside your self-imposed boundaries, here's some examples. There's no solution to the maximum tax on retirement plan assets. There's no tax savings on life insurance premiums. Lifetime exemption is only $12,300,000. I'm going to go back through these in a minute. You must pay taxes on investment assets, growth, and income. Double taxation on C corporation. Must pay full long-term capital gains on the sale of a business. Professional advisors are deal killers. So let's go back through them one at a time. No solution to maximum tax on retirement plan assets. I'm going to show you an example, and this is a presentation, not this exact one, but you've seen a presentation on buying life insurance inside qualified plans. But I'm going to show you really how simple this is. No tax saving on life insurance premiums. Well, if you pay for them personally, if you're in a 40% tax bracket, you've got a $16,000 budget, you're going to pay $6,000 in income taxes so you can make a $10,000 premium payment. But if you do it through a C corporation, the C corporation at a federal rate is taxed at 21%, where your personal rate is 37%. Let me add state income taxes. California, state income tax is 13.3. There's no offset of your Fed. So we got a 37% tax plus the 13%. So now if I have a $10,000 premium payment, I have to have earnings of $20,000, pay $10,000 in tax in order to have $10,000 left over to make my premium payment. If I do it instead through a C corporation, I wind up reducing that budget from 20,000, 50%, down to about 13,000. So there are ways to structure insurance premiums without deductions, just have the premium payer be a lower taxed entity. I hope that makes sense. The lifetime exemption is only $12.3 million. Well, there are ways, if you do some estate planning, you know about discounts as a means of creating lesser value for gift tax purposes. Well, if I take a 50% discount for lack of marketability and lack of control, and combine a GRAT and a family limited partnership, I can make a $12,300,000 lifetime exemption. I can make the asset worth roughly $6 million, which means that I could make my lifetime exemption a little over $12 million just by using some tools and techniques that tax attorneys are intimately familiar with. You must pay taxes on investment assets, growth, and income. Well, maybe, but you could also use private placement life insurance contracts where you have just a smidgen of costs for the pure death benefit. And if entered into the private placement life insurance correctly, you're never going to pay taxes on the growth again. You're never going to pay taxes on the income again, whether it be dividends or long-term capital gains. And you will be able to get access to the money income tax-free via the withdrawals up to basis and policy loans, just like a regular street product. Double taxation on C corporations. That's the big objection that accountants have. And the reality, it's more of a habit, because prior to 1988, professional corporations were taxed, which were mostly C corporations, by the way, were taxed at 15% of the last $50,000 of income. And if I remember correctly, about 20% on the next 25,000 of income. So almost all C corporations became almost all professional corporations became C corporations because of the fact that they could make better use of the money. But the CPA says today, because remember, 15% as opposed to 40% at the time, C corporation was a pretty good deal. In addition to the fact that there were deductions that I could get out of C corp that I can't get personally or through an S corp. So they got into the habit when 1988, when they said no, professional corporations need to start at the maximum tax rate, which I think was 40%. They went, well, why do we bother? Why don't we go to S corporations? And besides, assets left behind in a C corporation, number one, I could be penalized from a 531 accumulated earnings tax, meaning accumulating too much money in the corporation, even though it was done at a lower tax rate, without having a reasonable business purpose for accumulating the money. Well, I will suggest to you that a split dollar life insurance policy paid for by the C corporation, where the C corporation has a secured interest in the policy, is a reasonable corporate purpose to accumulate assets, because there was a penalty tax called 531 of the 535 on the 531 accumulated earnings that were too much, that at the time could make the total taxation 90%. So the whole idea is to use the C corporation for what it's good for, lowering the taxes, then take non-deductible expenses, having a reasonable corporate purpose, and use it to play that game. So there doesn't have to be double taxation. There's only double taxation on money that's left behind, nothing is done with it, and then at a later point in time, the individual is going to have to pay taxes on the distribution. All right, must pay full long-term capital gains tax on the sale of a business. Well, Brad and I and one of our members just helped a woman sell her practice for $22 million without including the hospital. For $22 million, she anticipated paying, I believe it was $6 million in long-term capital gains tax. This was also a woman who we got $1.1 million of tax credit, but that's not where the big value came. The big value came from a series of strategies that Strazzeri and team were able to put together to reduce what she expected to be $6 million down to $456,000. Some of it pure tax saving, some of it deferrals, but she gets full use of 100% of the money. Some of it charitable contributions in a CRT. So
and don't forget, we were talking about 34 days prior to her closing. So this was 2 years and a day. And yeah. I know nobody ever thinks about this, but this strategy also created two $10 million individual life insurance sales. So the advisor was pretty happy with the structure. Needless to say, that was the client.
With a spousal limited access trust, so husband can get access out of the wife's trust, and wife could get access out of the husband's trust. And to be honest with you, they don't really need the money. Professional advisors are deal killers. This is just something that our industry has grown to believe is true, and it's all because of the fact that they make all their recommendations on the client level and then ask the CPA to validate what they've presented. Usually the client is the one who dumps the insurance illustration on the CPA's desk. I've told you before, I'm going to tell you again, you never go visit the CPA where you've made recommendations to the client and expect him to say the equivalent of this: wow, is my client lucky that he ran into you? This is the best thing I've ever seen. I know I probably missed it. It makes me look foolish, but absolutely, I think you go ahead with your deal. Instead, what they do is they become very protective, and they'll say things, you know, I've heard of things like this. I'm not sure. You better be careful, or this doesn't work, or just ignore it completely. Bringing out that professional advisor, bringing him into the conversation early, getting the client excited about the potential savings and accumulations that you can create for them without telling them how, and then get authorization to go visit with the CPA and share the goals and objectives that we keep telling you is so unbelievably important, and asking them what their opinions are, what would they do, then sharing some of your thoughts as to what might be possible, allowing them to maintain their dignity, allowing them to retain the respect that they've attained, you will find that in many situations, you will be able to create an advocate as opposed to an adversary, which is why the reputation of deal killer. I hope that makes sense. Okay. Reducing the loss of taxes for the heirs of qualified plans. Now, you've seen presentations, but I don't think you've ever seen it quite this simple. Here's the problem. Current qualified plan net to heirs. Let's assume we got $4 million in the plan. Death occurs. The first thing that happens, and I rounded this off to 50% because it's an easier number. Right now, I know income taxes are only 37 at the federal level, but with the exception of a few states, everybody's got income tax as well. So I'm in California, we're at 50% or more. So the first thing that happens is $2 million is paid in income tax. Now we got $2 million left over. Now the estate tax, which I know is 40% today, and there's a lifetime exemption, but just follow the whole thought process. I'm trying to make it simple for the client to understand. So I got $2 million in income tax, $1 million in estate tax. There's $1 million net to the heirs. $1 million out of $4 million. So all of these people who are chasing yields, every time they make 10% on their money, every single time, the government winds up getting 8% of it, and the family gets 2% of it, net after taxes. You remember the old ad on television? It's not what you make, but it's what you keep. This is a classic example of it's not what you make, but it's what you get to keep. So out of this $4 million, 75% goes in taxes. Some of it today, some of it tomorrow, but that's what the reality is. So you've seen situations. How do we recapture the majority of a 75% loss in tax? Well, the answer is steps to replace loss due to taxation, qualified plan assets and cash equivalent. First, let's look at the current plan asset value. It's $4 million. Then let's purchase life insurance with that $4 million. We're not going to do it all at once. We're going to do it over 4 or 5 years. So let's say it's 5 years. So what's that going to be? To $500,000 a year for 4 years is going to be $2 million. $1 million a year for 4 years. Doesn't make any difference. You're going to purchase life insurance for $4 million. Here's the qualified plan assets. Here's the policy. So I buy a $6 million policy with the $4 million, purely hypothetical. The plan asset value, which was zero because I used it all up by buying the life insurance, I still got the policy, but then I have to purchase the policy. In order to get it outside the estate, I set up an irrevocable trust over the 4 or 5 years of funding, and I purchased the policy for 20% of premiums paid. Sometimes it's 15, sometimes it's 25. In this example, it's 20%. So $800,000 comes from the irrevocable trust, and they buy $6 million of income and estate tax-free death benefit, all guaranteed.
This seemed like a pretty good place to let everybody know about our upcoming Academy event, which is going to be virtual. So this will be, you can do this right from the comfort of your home office or any electronic equipment. You can broadcast, you can watch this technically from the golf course. But we have an Academy coming up here. I want to tell you a little bit about what is going to happen over those 3 days. We have our faculty, which are our experts, that our members all have access to as part of being part of the group. But we're going to bring in these experts over this 3-day period, and they're going to cover some amazing topics that can just be incredible. If you're not watching this at the event and have a notepad where you end up with 10 names of clients that you could apply that to, I'd be shocked because nobody ever does less than that. Just a great way to really enhance the tail end of your year here and get you ready for year end. It should be one of your best times of the year. So this Academy starts at 8 o'clock in the morning Pacific and ends at 3. We do about a 20-minute break for lunch in between for returning phone calls. If you get into the virtual Academy, the guests, the folks, those of you that aren't members, will have a week to be able to review the material. It'll be recorded, so you can go back and play over any of those parts as many times as you want. For the members of our group, by registering for the Academy, you have unlimited access to the recordings in perpetuity. Now, our members pay less than the general public. You can find the registration for this. In fact, we'll send you a link as soon as this is over also, but you can find our registration at www.yourctsr, your Center for Tax Strategies and Resources.com, and click on the upcoming events tab. Again, members, make sure you're going to the member portal and then register from there. If you need more information on what we've talked about today, or you just need some more information on why you would want to become a member of our group, you can call 877-258-2837, or you can email the center team at your CTSR, and we will put this up again at the end of the program.
Now the $6 million is outside the taxable estate. Now let's see what happens when death occurs. Well, my retirement assets are now $800,000. That was the purchase price of the life insurance policy. The income tax is $400,000 on the 800. The estate tax is $200,000. The heirs are left with $200,000. But the net to heirs is really $200,000 plus the $6 million insurance policy for a total of 6.2 versus $1 million. And might I suggest with you that $4 million of premium at the rate of $800,000 or $1 million a year for 4 or 5 years brings with it some pretty substantial compensation. But more importantly, we just increased by 6 times the amount of money the client's heirs was going to receive. That's a tradable example. Bradley, you got anything to say about that?
Yeah, I do. Let me bring my screen back up. What you just described, I went through a very similar scenario that you helped me through. I got kind of too close. This was the nice way you said it, Simon, but I got too close to the problem to see that there was a better solution than what I was proposing. So let me just do a high level flyover with you. Multiple meetings with the client. They already had a pretty substantial life insurance index UL properly structured and funded with about $600,000 in the cash value. Wanted to retire in a few years, like 4, and a couple $2.6 million, $2.7 million of qualified money. So I'm looking at this thinking, okay, if I have them do some withdrawals, take enough withdrawal to pay the tax on the withdrawal and put that money into the IUL instead of leaving it in the qualified. So just kind of spend down the qualified plan over a 7-year period. I would end up with a pretty substantial reduction in the total taxes they would pay between now and life expectancy. I couldn't come up with anything better than utilizing the tool that was in front of me. So I'm just about ready to present to the client. I said, hey, Simon, put a set of eyes on this a minute and tell me what you would do in the same circumstance. I've been looking at this crap for like 3 months. He looks at it in 3 minutes. And he said, okay, well, what I would probably do is I wouldn't be putting it into their existing policy. I'd reduce their existing policy. It'll probably carry, get an in-force illustration done. It'll probably still have substantial cash value in latter years. Take out a second to die, use that as the funding vehicle, funding it with the qualified money, take the $280,000 out, pay the tax with the 80, put the 200 into the second to die and let that run, see how it impacts. End result, $700,000 less in taxes than had they left the money in the qualified plan, and $2.2 million more in cash at their life expectancy, and $7 million more to their heirs. And you know, we don't make decisions based on commissions. Don't get me wrong, I don't do this for free. There really wasn't much commission in this for me to overfund an existing policy. And now it's about a $140,000 target, and the client's farther ahead. So again, we like to say we're not motivated by the commissions on the case, but I'll take them for the amount of time that we put in front of the client to be able to solve their issues and end up getting a pretty nice paycheck off it. These things he's talking about work in practical application. But let me tell you about another one. Do I have just a minute?
Wait, before you do that, wasn't there more to that case? Didn't she have what she thought was an access protection trust?
No, that's a different one. I was just going to cover that one next. That's okay. Yeah. The other one, same scenario. I love having a second set of eyes, but more importantly, it's opening up the way I think about solving a problem for a client. Did a bunch of research, did great discovery, figured out what she wanted to do, when she wanted to sell the business, estimated the business value, took a look at what her estate was going to be worth in latter years, applied for an insurance policy, got her issued Preferred Plus on a $3 million face amount. And she had a living trust. I didn't know it was a living trust. I was kind of ignoring the trust. But she's sweeping about 200 grand a year into that. There was $2.2 million in the trust. I wasn't going after that now. I figured I'd work on assets under management later with that. So I said, Simon, so here's what we've got. You know, we're looking at this case, nice size case. We can get this placed and she's ready to go. And he said, okay, why does she have a trust? And I said, well, to be honest, she explained to me why she set the trust up. It was because of a ex-husband that didn't last very long and she wanted to protect the assets. And he said, well, I'm not seeing a gift tax return, so I'm kind of assuming that's a living trust, not an irrevocable. And I said, well, let me get the documents. So we got the documents and reviewed them. Sure enough, he was right. The solution now just changed considerably because we're actually going to be purchasing a much more substantial life insurance policy inside the trust so that she's not taxed on those proceeds of the trust. We're changing it to a irrevocable trust so that she has true asset protection. Her end result, I haven't plugged all the numbers back in with Wealthy and Wise, but you're talking about right now, I know I've got $131,000 tax savings just off the structure of the trust proceeds and how what the kind of income the living trust was spinning off. We can now bury most of that inside the life insurance policy, still meet her income needs and have her in a much better position. And the target was about 3 times larger than the solution I had originally. So client's happy, and I'm actually meeting with the CPA on Wednesday of the client just to go through conversation with him and let him know some of the things that we've uncovered and get his feedback on what he thinks the next steps might be, and have him come to the same conclusions by the time we get done with that meeting. So,
by the way, thank you, Brett. I'm going to go back and discuss with you this woman that we said we thought she was going to pay $6 million on her long-term capital gains. She wound up paying $200,000 in legal fees. She thought they were going to amount to $250,000, so it came in a little bit under budget. But how many times a day? And by the way, the strategies that were used is nothing. There were no strategies used that everybody on this call doesn't know about. Nothing was used that everybody on this call doesn't know about. The key element was having the 400-pound gorilla, the 400-pound gorilla in the form of a tax attorney, the 400-pound gorilla tax attorney talking not only with the client and her husband, but with their CPA. I could have put together exactly the same presentation and gotten nowhere with it because too many wheels, too many buttons to push, too many things going on. I never would have had the balls to charge a $200,000 fee. She paid it willingly, and she winds up with an extra $6 or $7 million in her pocket. I'm sorry, $5 or $6 million in her pocket, and wound up doing asset protection, estate planning, and philanthropic planning at the same time. For those of you that aren't taking advantage of those resources, it's a major mistake.
Well,
it's a major mistake.
Stuff. I think those cases 5 years ago appeared to be an anomaly. They're becoming more and more regular. You know, there's aggregators out there buying up all kinds of different businesses. There's a lot of money on the street, and you also have an older population, my generation, that's selling their businesses now. And I'm getting 4 or 5 calls a week on, hey, I've got this situation. What should I do for my client? Or my client saying, hey, I just got an offer on the business. What should we do? I'll tell you what my steps are right now. It's the same they always have been. It's gather the data, get all the information down, and figure out how to bring in the right kind of resource and backdrop. And you know, Joe's amazing. Bruce is obviously amazing. In some cases, it might be just even Joe positioning the client to get a better number on the sale. I mean, all that stuff, it's incredible what a difference it is when you have that credibility at your side moving forward, because I'm no longer selling this for my client or for our member. I don't have to. I'm not selling anything. I'm presenting the solutions and resources. And I'm telling you, it's going to happen more and more, especially over the next few years. So buckle up.
And the important thing to remember is that you're not paying the attorney's fees. You're not giving up any commission. That's being basically done by having a client being edified with a professional advisor and having them say, yes, there's value here. And now all of a sudden, as we've always talked about, charging fees gives you more value, but charging fees on behalf of a tax attorney and getting more credibility that goes along with it is a major play.
Well, I hope you enjoyed the presentation. Simon's a very unique individual in this business. I've been doing this 37 years, and I learned more in about 6 months with him than I had in the 10 years prior. So again, do things the right way, do the things the proper way, and everything else takes care of itself. The client's needs get met and your practice revenue rises. So hope you enjoyed that. Again, just a little bit about the center. We are an organization that was put together for advisors. We have CPAs, we have asset gatherers, stockbrokers, insurance agents, financial planners that become members of the group. We've got members get access to about 1,600 documents that they can white label and use for marketing in their practice. We have worked out vendor arrangements with a lot of people in the business. Just as an example, Insmark, which we really like, the Wealthy and Wise software. You can get it considerably cheaper through us than you can get it through Insmark Direct. Reason being is we've put together a large enough group of folks that we've been able to get some really good pricing, and we don't mark that stuff up. We've got a lot of marketing programs, done for you seminars and webinars. If you want to find out more about how CTSR, the Center for Tax Strategies, can substantially increase your practice revenue, get in touch with us. Email the center team at yourctsr.com. We can talk about what the qualifications are for membership and see if we can help move your practice to the next level. Hope to see you soon.